if they had gone to that lender and said like, hey, look, we don't want to pay 20% down. We want to do 10% down. The lender would look at it and guarantee they qualify them. They'd probably charge them like 2% points up front. So they charge them $15,000 up front as a fee, one-time fee. And then they'd slap on mortgage insurance. And the mortgage insurance would come out to, it'd probably be about $400 a month. So say $5,000 a year in mortgage insurance payments, plus the $15,000 fee. They saved $75K on their down payment. So that means they can own that house for 12 years before they've paid out $75,000. Welcome to Service and Wealth, the podcast dedicated to helping military personnel master their finances and achieve financial freedom. Our mission is to guide you through the ins and outs of planning, saving, and investing, and most importantly, how to balance savings so you can enjoy life now and retire with confidence. Here we go. All right. Welcome back. It's your host, Ted Ahlert, on the Service and Wealth podcast. We're charging right along here. It's the middle of December. This is going to be the fourth episode in our series on real estate in the military. And, before we get started, I always kind of lead in with something that's on my mind. And the thing that I wanted to kind of share with the audience this week is there's self-doubt on my mind. Like, for the first time in a long time, I've sort of been like, oh, I don't know if I'm going to be able to do this. I'm not sure if I'm tough enough, if I'm going to be able to stick this one out. And I'm not talking about like finishing this series on the real estate podcasting or anything related to what we're talking about today or the podcast. Specifically, it's like there's this alpha dad flex thing going on. And I think I'm the only one who actually thinks it. But there's one other dad who is causing me all this doubt, right? We're in the middle of December. We've already had, a couple weeks like right above freezing where we live. Like in the morning, it's like in the mid 30s, but it's really windy. So the wind chill's like pushing down in the 20s. We've had a couple mornings when it was in the 20s and the wind chill was pushing it even colder. And like, I'm still just wearing, like, shorts. And, like, I'm shorts and, like, a sweatshirt. I'm just, like, all that time you spent in Hawaii, like, it thickened or thinned your blood out. Like, you got kind of, like, no disrespect for anybody with the terminology. Like, if you get triggered or have microaggressions or whatever. But, like, I felt like I was just getting soft, right? And, came back. And then we lived on the East Coast for wrapping up our last tour, and the winters hit, and I was always like, oh, I'm cold. Like, I wish I could wear like some sort of thermal shirt like underneath my dress blue Deltas, because it was like it's just a little bit thin. Obviously we don't, in the Marine Corps and the military, for our dress uniforms, we don't buy them because they're like high performance technical wear. We buy them because they're cheap 70-year running 70 year running contracts, which is, it's funny, right? Because there's these, at least in the Marine Corps, and like I'm sure in other branches, you can at least buy it, but it's not quite as like religiously worn. But like the Corps Fam shoe, like everybody calls them Corps frames in the Marine Corps because they just assume they hear a sound like that, and that must be what it is. It sounds like what you would call a shoe, but it's actually Corps Fam, and it's refers to this patented faux leather product that like 3M or DuPont invented back in like 1956, and they started selling it to department stores, and people were like, "Oh, shiny fake leather, that's cheap," and they realized like within 5 years that once it got scratched, you cannot repair it. So it was like a one and done product, and they're like, well, that's why it's a ripoff, and that's why it's cheap. So people stopped buying it, but the Marine Corps kept their contract, and now here we are, 70, 80 years later, and you go into the exchange on a Marine Corps base, and you go to buy dress shoes for the birthday ball or for promotions or just whatever, checking in, dress uniforms, and people are constantly buying these Bates Core Fam shoes, and they suck, right? Like, they're terrible. And the only reason why that company and that patent and that product even exists today is because government contracts have just got renewed year in, year out, right? So, anyway, I don't know how I got there, right? Talking about how our uniforms kind of, they're not, technically very well built. And so, like, you throw on that super thin, airy khaki shirt that's been pressed and starched and is itchy, and you're walking around in, like, 35-degree weather. And, like, I was, unlike for most of my career, through Quantico or, during the winters out in California or wherever, like, I was cold, So we moved here after I got out and moved over here to England, and I just set my mind to it. I was like, I was cold last winter. This winter, I'm gonna come out on top, and I'm gonna wear shorts and a sweatshirt. I'm gonna feel cold and be cold until I'm not cold anymore. Like, I'm gonna toughen up. But now it's turned into this, like, showdown between me and this other dad, and, like, we've both continued to wear shorts. We kind of, like, nod at each other across the parking lot, and but he just pulled a power move on me this past week, and it was cold and it was raining, so it was like 35 degrees and raining, and he brought the Crocs back out, right? So it was like, oh, dude, like, first of all, I don't own Crocs. Maybe I should, but I was like, I don't know if I can do that. But I think that that's sort of, like, not part of the competition, right? Because we started with shorts, with wearing your running shoes, your trainers, whatever you want to call it. And so, like, I feel like that's the baseline for the game. I don't feel like I have to go out and buy Crocs. But if he's going back to Crocs, there's only one of two things. One is he's bluffing, like he's ready to throw in the towel, and he's trying to psych me out. Or he's genuinely just, tougher than I am, and he's going to win this competition. He's going to be the alpha dad at our school, and I'm going to lose. So that's where my head is as we're coming into today's episode. And I'm also my whole family's kind of bouncing back from norovirus, which is, you probably had it, you might not. It's some sort of weird combination of, like, it starts out like COVID, where, like, you feel like you got just thrashed on, like, bull in the ring, ground fighting for, like, 5 different people for 5 rounds. And you wake up the next day and you're like, oh, why does my neck, shoulder, back, leg, knee, everything hurts? And then you think you're better, and then all of a sudden it turns into, like, a flu, and then you think you're better, and then it's a cold. So excuse me as we get into this if at any point I gotta clear my throat or anything like that. It's not trying to distract, but anyway, so what I want to do is kind of amend the plan, right? So this is the 4th episode on our series on real estate for the military. We really tried to, like, kind of stay away from it for the first couple months of the podcast and use those initial months to kind of build up our mindset of how we've got to use the tricks and the mindset and the tactics and the knowledge, that the wealthy use and that businesses use and corporations use. And we've got to develop that mindset and that financial IQ and push out, like, sort of all the run-of-the-mill, like, what your mom and dad taught you, what you might have learned in, like, a high school economics course, if you had anything like that, or a personal finance course, or especially the stuff that you're going to, that you have learned or you will hear from, like, your command financial specialist, or, the community services in the Marine Corps. It's Marine Corps Community Services, so I'm sure it's also, like, Army Community Service, Navy, Air Force. I'm sure you guys have the same thing where they kind of, like, they're a company that makes money, but they act like they're there to help you. And they come out and do classes, and they're like, hey, let us tell you, or back at the Naval Academy, they had a command financial specialist who would bring in, and they had their support activity, and they would put together these classes on, like, how to use your career starter loan as a down payment and get another loan to buy a car. And if you're brand new, or if you've been raised as like the typical financially uneducated, illiterate bottom 90% of Americans, then you would be like, oh, that is a great plan. Thank you for showing me how to do that. Now I can get this $30,000 car. And even though I could, I have this loan, so that's, financed, might as well use that borrowed money to put a down payment on a car and take out another loan. And now I've got $50,000 in debt right out of college, right? And like, hopefully at this point, after 5 plus 6 months, in listening to the Service and Wealth podcast, hopefully you went out and bought our book, Service and Wealth, which is available on Amazon either as a Kindle or as a paperback. Like your mindset is coming along where you start to see that and you're like, wow, that is dumb. You're putting yourself in a debt trap, right? You're buying something you don't need. You're using and you can't afford. You're using borrowed funds. You're increasing your debt payments and your debt load to a level where you're not going to be able to go out and qualify for a mortgage to buy a house, right? And so you're like, that's a bad idea. And that's really where we want to get to, because now that we're, in the 4th episode on this real estate series, sort of like mini course or whatever you want to call it, podcast within a podcast, we're going to start talking about home buying and the VA loan and how to think about and make choices about how you're buying a home and what home you're buying and how you're going to structure the financing and whether or not you do a down payment. And we're going to say things that you probably haven't heard or haven't thought of before, because it requires you to just be like a little bit more wise about your money. And as a preview or example of what I'm going to talk about in one particular case is most people, let's just assume that we're talking about like a conventional home loan. And a conventional home loan not backed by the VA, the typical, setup is 20% down, finance 80%. It's not a rule, right? It's not a requirement. Your lender may not allow you to put down less of a down payment if your credit score isn't that strong and if you don't have a very, like you're trying to take on a mortgage that is the full amount of, that you can qualify for. But if you take a step back and you buy a good starter home that doesn't suck up all of your lending capacity, like the amount you can borrow, and you have a good credit score because you didn't finance a car, you don't carry credit card debt, you've made on-time payments on everything else, you got a credit card early and have established credit history, and then banks will let you buy houses with 15% down, 10% down, sometimes even less on a conventional loan. And the only thing they're going to do is they're going to charge you mortgage insurance each month, which is, if you have a good credit score and they actually qualify you to like buy with 10 or 15% down instead of 20, the mortgage insurance is going to be about 1% of your the total loan amount per year, right? And most people are like, oh no, don't do that. Like, that's terrible. Look at all that money you're wasting with mortgage insurance. And I'm going to talk today, I'm just going to explain the numbers that show why probably 9 times out of 10, like, you absolutely should do that. Take the lower down payment and pay the mortgage insurance, right? And it's just a dollars and cents, calculation that you got to look at. So anyway, to get back on track here, right? We've gone through the intro, got a little bit of a reason explaining why we've held off so long to talk about real estate, and now we're like really diving into the importance of you having this financial wisdom that you've built up and having this mindset that kind of like jives with not going with the crowd, not following the lemmings, not following the herd, not getting swept away by popular beliefs or misconceptions, or getting stuck in pitfalls because you didn't know, right? We should be well positioned now to go ahead. And I had mentioned or teased earlier that I had to make a little bit of an adjustment to the plan, right? And I initially had said, like, let's do a 4, maybe 5-part series on real estate in the military. And, the first one, we really just started the fundamentals. Like, please understand the contracts and the ownership and the legal terms behind real estate before you get started, so that you know where the ownership is, what you have to look for, and you don't find yourself, in trouble with buying a property that's saddled with some encumbrance that's going to potentially cause you to lose the property in the future through no fault of your own, et cetera. Then we talked about, in the second episode, we talked about the actual process from, researching on your own months in advance before you're ready to buy. So you teach yourself the area, the market, and then the people who you're going to need to work with and what they do for you. And when you have that kind of knowledge, now you know what to look for on paper and physically with the property and the records. But now you're with the people you're dealing with. You don't just hand them your checkbook and be like, show me what I should buy. Tell me what to do. This is how much money I have. Blah. Right? You can screen your team, make sure they understand what your goal is. You're not trying to get maxed out by the bank so that you are, half of your paycheck every month is just paying the mortgage, right? You don't want that. You'd rather have some spending cash, a smaller house, but enough spending cash. Every weekend you can go out pursuing your hobbies. You can take your kids to do fun things. You can go on date nights with your wife and not stress about it, because your mortgage is killing you. And how to screen and make sure that the agents and the loan officers who work for you, and you should think of it that way, they work for you, right? You don't have to say that to them. You can say, work with me. But it's your money. It's your property you're going to buy. It's your investment. You got to do what's best for you, and they should be doing what's best for you, even if they're not bound by it, right? There's no fiduciary, in finance, there's certified financial planners, there's certified financial analysts, there's also certified financial fiduciaries, CFFs. And those are the people, if you're going to pay a lot of money, those are the people you should look for, because their license says that they must do what's in your best interest. They can't just tell you to buy a product because their brokerage sells it. And it's not like that in real estate. And, just because an agent has a license and a broker has a license and a loan officer has a license to, sell you loan products, none of them are actually required to do what's best for you. So you got to watch out for yourself. And then last week we went through the 5 C's. We were talking about closing and contingencies and making and getting to the contract and all that kind of stuff. And the idea was we come back this one and the fourth one, we talk about the VA loan. And then we dangle out the possibility of a 5th episode on a strategy, a career-long or lifelong strategy on how to integrate the VA loan and use it multiple times and acquire multiple assets and build a portfolio of rentals that bring you enough money that on top of your military pension and your VA disability and the money you get from your thrift savings plan savings, you can retire early and live a super comfortable life. But what I realize is today we've got to take it's like a 4A, where we just got to kind of talk about what it means to finance and what mortgages are, and just make sure that we understand the different parts of it, so that then that means 4B or 5, I don't know why I overcomplicate it, but our next episode, when we talk about the VA loan, we can really target and focus in on it and explain, this is the VA loan, this is how to use it, this is what to do, this is what not to do, without having to, without I shouldn't even say having, without taking my typical, 5-minute digressions to, explain something, right? I don't need to tell you, okay, listen, on the VA loan, one of the advantages of it over a conventional loan is you don't pay mortgage insurance. And you're like, mortgage, is that homeowner's insurance? What is that? You already told me in episode, 1 and 2 about that I got to have title insurance, but now I have to mortgage, what's all this insurance stuff? We got to kind of talk about that a little today. Then we got to talk about the VA loan, which would be the 5th episode. That would make the 6th episode, definitely a strategy roadmap for and my thought is talk about what you can do if you're only in for, let's say, 8 years or less. So maybe 1 reenlistment or 1 officer's contract, maybe, with an extra couple of years. Or if you're in for 20 plus years, right? And it's not just because of the different timelines and the ages and the entitlements and the income and all that stuff, but also just the sort of the complexity, right? The geography of things. And then it really makes sense to come back after that and do another episode in which we talk about the ways that real estate can make you money, how you need to know those and look for those so that when you're considering what to do with buying a house or buying an investment property or keeping a house that you lived in and turning it into a rental or selling it, you know all the things to look for and kind of like figure into your calculations. And then alongside that, you know, it'll be like a pros and cons or do's and don'ts of real estate investing from, you know, not like, you know, General Mattis's flat ass rules, but like sort of from our experience. Because alongside that, then we want to talk about ways that you can like lose money, right? And like some of the mistakes to avoid. And then, you know, that would be 7. And maybe there should be an 8th, and maybe that'll pop up. So I think it's really going to stretch out there. We might take a break in the middle to talk about something else if something comes up, but that's kind of where we are. So, you know, as we make that adjustment and get ready to jump into the content, I'll take a quick intermission here to remind y'all that you can find us at www.militarywealthcoach.com. If you go over there, you can sign up to be notified on this mini course that we're building, which is taking months longer than I ever expected because I keep screwing up the technology, and I'm sorry. Like I cannot, for the life of me, like manage to record and upload a video on top of a PowerPoint that's animated. Even though I have the software, like I watch YouTube videos. It's like, this is how you do it. I'm like, I'm doing that, and it doesn't work. But you can also, what's really cool is you can, you know, we have a free coaching session that you can sign up for there. And, you know, that'll be about 45 or 50 minutes in which we'll sit down on Google Meets or, you know, WhatsApp or whatever makes sense. And we'll talk about whatever questions you have about your personal finances or your investing goals and see how, if, you know, either answer questions or maybe find a way that we could have a ongoing relationship and we could help you there. And then also you can find links to all our socials. So, and at any time, if you want to suggest an episode, if you have a comment, if you want to disagree, if I missed something and you need, you know, you want to call me out on it, you can DM us through, you know, LinkedIn is great. LinkedIn's probably preferred at this point, or Facebook, Instagram, TikTok. Just search for Military Wealth Coach and you'll find us. And then also, you know, just to extend the challenge that every week, find someone within your unit, within your friend group, who, or, you know, you're just at lunch with a bunch of, you know, other NCOs or officers from kind of around the base or around the bigger unit, you know, maybe from the wing, and you just all happen to be sitting there and people are talking about, you know, finance, investing, TSP, BRS, VA loans, any of that, and you'll hear them asking questions and saying things that you know are wrong because you tune into the podcast here and you've read our books and read the blogs, and so you know they're wrong. But instead of arguing, just share a link to the podcast, right? And let's keep growing this community and get more folks out there listening. And, you know, especially if you do enjoy the podcast, please, if you're listening on Apple Podcasts or on Spotify, because we're both those places. We're also on YouTube because YouTube now integrates podcasts. Like, please give us a 5-star rating and help us continue to climb up the rankings there and search results. And, of course, also the standard disclosure, right? I'll just keep it short and simple today. Do your own research, make your own decisions, and own the consequences of those decisions, right? And I think that's what really sets us apart as a military community going into investing, and especially real estate investing, is that we've been taught our whole careers, and hopefully from even earlier in our lives, to be accountable. And I think that's a huge thing, right? And what I mean by that is, if an investment goes sour, right, like, don't look for people to blame, because there may be nobody to blame. Or maybe you're the person to blame. Look at it as objectively as you can and look for ways to make it right, to get out, to recoup the loss. and definitely do your hot washes and look at things that you can do better next time. And that's super important. I got to say, 8 years in real estate, like I'm always thinking back to the mistakes I made or the things that I forgot to look at on the last one. And I'm like, don't forget that. Just don't forget it. Like write it down, because when you go to make an offer on this one, like you can't make that mistake. And I'll talk about at least one of those examples in our VA episode coming up next. All right, so sorry for the pause there. Like I said, coming back from the norovirus, had to kind of clear my chest out there for a second. Okay, so today, episode 4, we're talking about like basically like what's a mortgage, right? Like what does it mean to finance a home? And there's kind of like 3 parts to what we want to talk about today. The first one is just the whole notion of financing and sort of like the pros and cons of it, especially like in the U.S. I'm going to talk really quickly, just kind of explain about how things work from the financier, like the bank side of the house, and what's called the secondary market. And it's you might treat it as like a little academic or like too much like history, but it's super important to understand because it shapes everything that you actually see as that person who's going into the bank and trying to get a loan to finance a home purchase or a real estate investment property. Like, why are you limited by X, Y, or Z, right? Like, why can I only qualify for this much? Why are they not willing to lend me more than this much? Why is and as we'll talk about in the next episode, like why will the VA not let me do more than this? Like it all comes from understanding this bigger picture. And I think it's really important to know, and it's only takes 5 or 10 minutes to cover it. And then we'll finish up by just talking about basically like once you get the loan and you close on the house, and now you're suddenly paying a mortgage, and talk about like the monthly payments and the loan balance over time, just to kind of familiarize yourself with, what you need to pay attention to. I mentioned earlier, like mortgage insurance is a thing to pay attention to. Thinking about interest rates, right? Like what I mean by that is it's insane to watch in the U.S. housing market because it's largely driven by non-investors, non-banks, company groups. Like just like 70% of homes are bought and sold by American families, right, or individuals, and most of them are totally unsophisticated, and so they might be running out and buying houses when the interest rate's 5.75%, but it goes to 6.25%, and all of a sudden they're like, I can't do it, right? And it's like, for what reason? Like, because your mortgage payment was going to be an extra $100 or $200 a month, you're not going to go out and still buy a house and start letting it appreciate in value and investing in the equity of your property instead of paying rent to a landlord. You're going to do it over, we're talking about $5, $10, $20, $30,000 worth of retained value for you every year that you own that house from equity pay down and, savings from tax deductions and, and other such things compared to paying rent, but you're going to sacrifice that over like $100 a month. And so we'll just kind of like wrap up with that. And then that'll be our transition. We'll probably go get a drink of water and come right back and record episode 5 of the series. And just start talking right away about the VA loan because that's the perfect transition into the VA loan. All right. So first part, like module 1, right? Talking about financing. Like I've done some numbers in some online calculators and just to try to like have good examples ready at hand to share as we talk about this. And I picked the number 300,000 for the purchase price of the home. And there's a reason for that. So, excuse me. Here we are in the end of 2024. Most people are really buying into the narrative that you get in the media that it's impossible to become a homeowner anymore in America because the average home sales price in 2024 shot up past, $430,000. And at a 6 or 7% interest rate, when you add in taxes and insurance and the cost of home ownership, we're talking maybe like $4,000 for your monthly, your monthly total cost of living for your housing, right? Because if you got to go out there and you get a $400,000 loan with a 7% interest rate, you're looking at about $3,000 for principal and interest, and we'll explain that a little bit. Plus, you got to pay taxes. Plus, you got to pay insurance. Plus, you're going to pay, your utilities, and like that amount of money spent per month, $50,000 a year. That almost matches the average, or the median salary per worker in the U.S., right? So it's like you have this idea like, no, it's probably not affordable. And we're not even talking about the down payment on a house like that. But that's just, it's a famous, or one of my favorite, maybe it's not that famous, but like a cliche or a quip, and it says like, there's lies, damn lies, and statistics, and people all the time are like, well, the statistics say, statistics aren't the truth, right? Like, it's just reporting on one thing in one way. And so saying that the average house in the U.S. in 2024 is $435,000, and therefore, it's just not affordable for an American to buy that house. It's a statistic, but it's a lie, right? Because that takes into account all of the big, ritzy coastal homes, all of the prices of homes in like the really expensive markets like, New York, Washington, D.C. area, California, Washington, Hawaii, Alaska. If you start to take that out, and in fact, it also includes like, it's not really constrained by like the size of the house. So if you take those out, obviously the average price of a home goes way down. For $425,000 in Texas, now you might not be able to afford the property taxes, but if you had that much house, you would be talking about like, I don't know, 4,000 square feet, like a 6-bedroom, 5-bath, like 3-car, like massive mini mansions that you can buy for that. You can buy like a 1-bedroom apartment for that in downtown LA or in New York City, right? Probably not even in New York City anymore. But that is to say, that's not the truth. If you peel it back and you look at some different statistics, you look at what's the average starter home cost in the United States. Again, across all states. So you're still going to have places where it's cheaper, places where it's more expensive. But we're talking about a simple 3-bedroom, 2-bath ranch, usually with an attached garage. Doesn't have to be. But it's about 1,500 to 2,000 square feet. And those houses in 2024, on average, cost about $196,000. So less than half of what the national average. You can still go out and afford one of those houses. Now, if you get, if you're in the military and you're getting BAH, and you hand all that over to a loan officer and they start calculating beep, boop, beep, boop, beep, and they see that your total, include your partner if you're married or not, whatever, but they see like you can qualify for, and I should say, obviously, if you can buy a house for $200,000, even at like a 6.5% interest rate, that's going to bring that monthly principal and interest payment down to like $1,400. Add taxes and insurance, and for less than $2,000, like you're a homeowner and you can pay the mortgage. So it's much more affordable than twice that for twice as expensive a house. But if you go in with your paperwork and give it to the loan officer and the agent, and they find you can afford that $400,000 house, that's what all they're gonna show you, and you're gonna think you're gonna get like frustrated. You might get suckered into buying it and over leveraging yourself. But the point is, like, for $200,000, you can get a great house in almost every state in the country, especially where most of our military bases are. Even in parts of California, that is within your reach. Or maybe you just buy like a townhouse, right? You don't get a single family home, so you spend even a little bit less, and you buy a townhouse or a condo, but you get your foot in the door. And the reason why you can do that at all is because of financing. And financing is taking a loan from a bank to buy the house, right? And this is important for two reasons. First, you have to make sure that your agents are, especially, and we'll talk about this again in strategies when it comes to using like a VA loan or an FHA loan, but sellers often favor cash offers over financed offers, even cash offers for less. And they do it for three reasons. The first is a cash buyer can close sooner because they don't have to wait on the bank to do all of its due diligence and underwrite the loan and, release the funds. So, a cash buyer could maybe come pick up that house in like a week or two instead of a month. A cash buyer seems more reliable because they are saying they have enough cash. So it's kind of like, well, this person must be loaded, so obviously they can afford it. But the third and the weird one is that sellers tend to think that they get more money when they sell to cash buyers. So they get more money if they sell to somebody using a conventional loan who puts 20% down compared to a VA loan with 0% down. And I don't know why that happens, right? Because this is the way that the whole process works is you find a house, you get a sales contract, you sign the sales contract for a sales price, take that sales price over to the bank. They see if you're qualified, do all their due diligence. If you are, and again, we're saying $300,000 is the number we're just going to stick with for all our examples. They don't give you the 300 and then like you sort it out and give it to the seller. The $300,000 transfers to an escrow account that's managed by the title agency escrow office, because they will then release the funds directly to the seller after they take out all the bits for the seller's agent commission, the buyer's agent commission, the title work preparation, the title insurance, the taxes in advance, interest paid in advance, all that stuff. Like that's done at that central hub. And then, so it doesn't matter if you put 20% down and borrow $240,000. The 20% down, the $60,000 you put down is going into that escrow account along with the $240 from the bank. And they're going to sort it out, and then they're going to cut a check. They're not even going to cut a check to the seller. They're first going to cut a check to the seller's lender to pay off that mortgage. And then whatever's left over, they're going to put in the seller's bank account. And it doesn't matter also if they went with a cash buyer, because the cash buyer is not just going to give cash straight to the seller. The seller, people have probably gotten killed, as recently as 2024 for doing this, but like, if you just gave a seller $100,000, said like, okay, I'll be back for the keys tomorrow, and never recorded title with the county, like we talked about, back in the first couple episodes, that changes the ownership officially. Like that's the whole point of the escrow office and the escrow account, is they don't release any money to the seller until they have seen the signed paperwork, the signed deed, get sent over to the county recorder. And now they know the county recorder is going to record it that now you're the owner. And so then they give the money. They do it simultaneously. You get ownership with the deed and the seller gets their proceeds. So like, it shouldn't ever matter who's making you the offer, the cash buyer, the 20% conventional financing, or the VA loan. If they have a pre-qualification letter, that means the bank has already said, yes, we're going to get this for them. They are going to be able to pay for it. And the escrow officer is going to shave every fee and cost and deduction off the top. Again, whether it's cash, conventional, or VA. And that seller is going to walk away with the same amount of money, right? And so really the only difference when it comes down to it is that cash can get you there sooner, all right? So financing is, that's where the loan goes. It comes from the bank. It never touches your hands, never touches your accounts. You just get the bill, right? And all the proceeds go over. Why should you do this? And most people, they start to get really itchy because it's a lot of money. It's a big number. It's 30 years of payments generally. and they get really itchy about it, and they're like, that's too much of a commitment. Like, I'll just keep renting. It's fine. It'll be fine. We'll make it. And they never make the jump into becoming a homeowner or investing in real estate. But it's a huge mistake, right? And it's because of the financing available. Now, let me ask you this. If you could buy 100 shares of, let's say, Google stock or NVIDIA, or, pick your stock you like. If you could buy 100 shares and each one costs $1 and you had to pay $100, would you rather do that? Or would you rather get 100 shares and only have to pay $20? Because you borrowed 80 from somebody to buy those shares. And then in 5 years, when the stock is like 10x'd, you sell all 100, you get to keep the profit on all 100, and you only have to pay back $80. So now you just have to think about that, right? Like, the financing, one, it lowers the barrier to entry. And with the case of the VA loan, all the way down to almost $0, almost free. You can become a real estate investor and homeowner by borrowing money. You borrow $300,000, you buy a $300,000 house. It goes up and you sell it for $400,000. Like, you only have to pay back the bank the $300,000 you borrowed. You get $100,000 profit. And you could do it for almost free. So it lowers the barrier to entry, and it gives you this chance to make loads and loads of money on this thing called leverage. And so leverage is borrowed money that you're using to buy or invest in something. And the more you borrow, the higher your ratio goes. So what I mean also by that is, let's say I put 20% down on a house. So it's a $300,000 house. I put 60 down, borrow $240,000. That's a 5-to-1 leverage. If the property goes up 10%, so it goes from $300,000 to $330,000. If I was a cash buyer, I would get $30,000 profit on a $300,000 purchase, which means I made a 10% profit. By using financing with 20% down and 5x leverage, I sell the property for $330,000 that I got for $300,000, but I only had to pay $60,000 to get. So my profit is 30 on 60, which is 50%, right? It's 5 times more profit. Now let's say that you qualify for a conventional loan and you ask the lender, hey, I would like to buy this with 10% down. Can you do that? And they look at your credit score, your payment history. They're like, yeah, actually, you qualify for this. It's going to cost you an extra half point interest rate percentage and some mortgage insurance every month. $200 a month and $150 a month in mortgage insurance. But yeah, you can do that. So now you only had to pay $30,000 to get a $300,000 property. You are at 10% down is 10x leverage. So then if you sell it for $330,000, the $30,000 profit comes on a $30,000 investment. That's 100% profit, right? So, and then obviously if you use a 0% down VA loan, you have zero in and you get $30,000. That's like $30,000 for free, right? So using financing is a powerful tool because it lowers the barrier to entry for you to get in and become a real estate investor and a homeowner. And it also gives you the ability to massively increase your profits and your return on investment. So it helps you rapidly increase your wealth. And that's why we're such fans of it for the military community, because of the first example I shared. You can't go out and buy 100 shares of Apple by borrowing money from the bank. It's too risky. They don't do it. So if you want to make $30,000 and double your money in Apple, you got to have $30,000 to buy Apple stock. And then you got to hope it doubles. But with a VA loan, you could buy Apple stock for free. And then when it goes up, sell it and make $30,000, right? So it's just a highly efficient way to build wealth over the long run. Not overnight at all. Not even over the course of a few months, unless you get into flipping and doing rehabs and stuff like that, which maybe you will. But it's great for that reason. And so I kind of want to transition now into like just talking about the history and like the rules and the laws in America and why this happened. So America and its government, right from the very beginning, was super oriented on growth, right? Because we were a poor colony of England, of Great Britain, the crown, whatever you want to call it. And for a long time, they had taken advantage of us. They'd forced us to buy their products. They forced us to produce the raw materials. Then they would take it back to England, assemble it into more expensive stuff, and they forced us to buy it through treaties and other rules. And we really didn't like it. And so we had this idea. We're like, you know what we need to do is we need to industrialize in this country, and we need to set up the rules to incentivize that people will have homes, they'll own property, they'll want to care for the property, they'll want to invest in the property, they'll want to buy stuff to put in their property, they'll have jobs, they'll have electricity, power, well, obviously not electricity way back then, but, you know, they'll have public services. And so we made all these rules, and part of it that came along the way, you know, as we really, over the centuries, by the mid-1900s, we really, really wanted people to be homeowners, is we came up with this 30-year mortgage, right? And it's like unheard of. There are, I read someplace that there's like 5 countries in the world that have real estate financing and bank financing laws as user-friendly as America. But this is like, it's like the golden ticket, right? It's not a tactical weapon like the VA loan, because it's everybody can finance it. Everybody can get a 30-year fixed mortgage. And why is it such a golden ticket? Well, when you take out that mortgage, you're locked in at that interest rate and at that payment for 30 years, if you want to keep it for 30 years. That means if you go out right now, VA loan is at 5.99%, and you buy a $300,000 house with 0% down, so you have a $300,000 loan. Over 30 years at 5.99%, your monthly payment is going to be about $1,800 forever, right? Like right now, that might stress your budget. You know, maybe you're like a married E4 who's getting BAH, or maybe you're like a, you know, O1 or young O2, and you're like, dude, that's $1,800 a month. Like I was just paying $1,000 or $1,100 in rent. That's a big jump. But 5 years from now, when your BH is double and your base pay is double that, I guess not double, BH, depending where you are, but maybe 10 years, right? Like, you get my point. It's still just going to be $1,800, right? And so that's a huge deal for you. You're locked in. The banks can't come back. They can't increase your payments. They can't increase your interest rate. They can't mess with you. If you go to a place like England, which we often think is like got to be just like America, right? Like generally pretty much same freedom, economics, profit, like same interest. Every like 4, 5, 6 years, it doesn't matter what loan you have, the banks come back and they get to decide if they're going to raise your rates. Everything's an adjustable or a variable rate all around the world, right? There are some countries where you can't even get financing, and you definitely can't get it on a 20% down. Some countries, the best you can do is 40% down, right? So you can get in cheaply with American mortgages. You get locked in for 30 years, and it's really safe. Well, that's a problem for the banks, right? Because a bank doesn't want to give you $300,000 and wait 30 years to get it back. They want it back soon. And if they had their choice, they would never lend it to you. They would take that $300,000 and they would give it to like a construction company or, you know, a oil and gas mining company, right? They would give it to a company, a business that has revenue, is profitable, and that has a plan to like invest or build something over the next like 6, 12, 24 months and then pay it all back. So they're going to get the interest, but then they're going to get the bank's going to get their $300,000 back really soon, in like a year or two. And that's way better than waiting 30 years. And so what the U.S. government did is they created 2 companies, and this might sound familiar, but they're called Fannie Mae and Freddie Mac. And they're mortgage companies that buy mortgages from banks. And so what the U.S. government just did is they said, okay, look, banks, you go out there, you write all these loans. We know you're going to charge origination fees. We know you're going to charge points to, like, you know, create the loan. So for that $300,000 loan, you're probably going to charge the person like $3,000 just to give them the loan. So you get a little profit up front. They're going to start making interest payments to you. And then within a year, we're going to come and give you $300,000 to buy that from you. So you're going to get all your money back. Plus in that year, 6 months or a year that you had it, you got the interest payments. So you made profit. You'll make 5 or 10% profit on that loan. And we're going to give you your money back. And the banks are like, oh, really? Well, that's risk-free. Now we're not even, like a business or a construction project. They could have problems. They could go bankrupt. They could go, big things could happen. But the U.S. government buying these loans from us, that's a sure thing. Like, that's a home run. Like, slam dunk, we'll do it, right? And so they did. And so that created not just these companies, Fannie Mae and Freddie Mac, but it created this massive thing called the secondary market, where mortgages are bought and sold, right? And that's why if you are a homeowner, if you have been a homeowner and you've had a mortgage, one random day you're going to get something in the mail, maybe from like Lending Tree or Wells Fargo or Rocket Mortgage, and it's like, hey, we're your new loan servicer. And you're like, what happened? What's going on? All that happened was that the piece of paper was just getting sold, right? Sold. Your payments don't change. You still send it in, the same due date, the same amount. Nothing changes for you. It's just somebody else owns it. And that's a way that Fannie and Freddie can keep recapitalizing, right? They can't just constantly buy mortgages and hold them forever. They then will sell them to other servicers so they can get their cash back and keep buying new mortgages that are written by the big banks. And so we have this system in America where we figured out how to make the best possible financing to make home ownership affordable for the buyer, for you and me, but still profitable for everybody else who's the big banks and Uncle Sam. And that's what's going on in the background. And, we won't talk about it right now, but it's the fact that exists. That's why we had the Great Recession and the housing crash back in 2008. If you've seen the movie The Big Short, that's what it's all about. If you haven't, go watch it. Or just YouTube the housing crisis, Big Short, and they'll explain to you. And now you'll have a better idea of why that stuff even exists, right? But there's some other implications for that are important to understand, and that's in order for Fannie and Freddie, for the U.S. government to legally purchase these loans on the secondary market, they have to conform to certain standards. And so they have to conform to things like a certain credit score, right? If your credit score is below 580, good luck. I don't know if you're ever going to be able to get a loan. If it's below 620, you have options with the FHA and possibly the VA loan. But you pretty much got to be above 620, right? And then there's also conforming loan limits, right? And the conforming loan limits are set just based on, it's generally kind of arbitrary. But it's not important who sets them or why. But for 2024, the conforming loan limit was $766,550. And that's most places nationwide. Doesn't matter where it comes from, but the reason why it's there is just that. They said that is as much as any one borrower in the United States should be able to have. And so that's the biggest loan that Fannie and Freddie can buy from a bank. And so a bank now has a limit of $766,550 that they should be lending to you. If that sounds familiar because you've been reading up on the VA loan and it's the same number, that's why it is. It's not the VA decided randomly that people in the military aren't trustworthy and should only be able to borrow up to $766,000. Came the opposite way, right? It came from the federal government saying this is the most amount of risk per home buyer in the U.S. that Fannie and Freddie can take, so that's the conforming loan limit. It's got to be less. And you say, but I know because I'm stationed in Southern California, or I'm stationed in Seattle, or I'm stationed in Hawaii, I know that you can actually get a bigger loan than that because a VA loan. I know I can get $1.15 million as a VA loan where I live. It's just because it's so expensive where you live. And they allow that, right? Because that's basically how much it costs 50% more to get the same house because the cost of living is 50% higher. The cost of housing, 50% higher in those. So there's a by-county exception for that higher amount. And that's for everybody. That's conventional loans too. It's not just the VA because that's what Fannie and Freddie will buy. If you go above the conforming loan limit, you have to get a jumbo loan, right? And so you might have heard jumbo loans if you've been listening to like Bigger Pockets or you've been reading up on real estate or blogs or whatever. You might have seen jumbo loan and just like pictured like $10 million are really huge. Jumbo loans are just anything above the conforming loan limits. Why? Well, they're special because now if that bank, like, the Mutual Bank of Omaha, right? Like you go to them, you're like, I want to buy this triplex. It's $1 million. I need a loan. Well, they could give you that loan, but they now know that Fannie and Freddie can't buy it. So they're probably going to have to keep it on their books, which means that they can't sell it. They have to keep the loan. And that probably means they're not going to give you low interest rate or 30 years or a fixed rate. They'll probably charge you a higher interest rate. They might require you to have a certain amount of cash reserves in a bank account at their bank to cover like 6 months of mortgage payments so that, if you were to lose your job or disappear, like they would have enough cash to, cover the cost of the loan and make sure they make their profits. And also you're going to have a higher credit score and probably a higher income, right? So it's probably very unrealistic for anyone who's, of entry level or on the officer side or like NCO or below to ever even consider getting a jumbo loan unless they're already doing amazing and have like massive amounts of side hustle income that they can prove, right? And so that, it's just really important to understand that whole big context and why it happens, and then what the consequences are. If you decide like, well, I'm an 04 California to go, I'll be stationed at Navy Pier, and I want to buy this $900,000 house. Well, if you go buy it in like, India or, probably not even India, but, let's just say like you're someplace out in the boonies, that might be a jumbo loan, right? If you're right in downtown San Diego, first of all, you're not getting a whole lot for that. But it would qualify under the 1.15 cap. But just the point being, like, if you're like at the end of your career and you're ready to retire and buy this like big amazing house and like take out a massive loan and it's above the conforming loan limit, you're going to be talking about a jumbo loan. You're going to have to pay higher interest rates, different terms. You might get a variable. There might be a balloon, right? So it's just kind of worth thinking about and understanding. And so, but we're assuming you've taken out a conforming loan and it's VA loan, conventional, whatever the case may be. And so you've bought the house, right? And like we said before, the bank gives it to the escrow account. The escrow account disperses it to the seller. You never actually touch the funds. All you get is this mortgage statement every month. Well, what is that? So when you get this mortgage, they lend you $300,000. They don't want to wait 30 years to make all their profits. So they charge the interest. They front load the interest. Everything is like daily accrual. They might not let you pay off faster. There might be prepayment penalties because they want that maximum interest. And on a $300,000 VA loan, 30 years, 5.99%, that has an $1,800 a month payment, for the first year, only about $300 is going to go to paying down your loan. $1,500 is pure profit of interest to the bank. In fact, if you, in one PCS cycle on this house, if you make 3 years worth of payments, that's 36 months, $1,800 a month. I'm going too slow on the math. That's $64,800 worth of payments over 3 years. You're going to pay just under $53,000 of that is going to be interest, and just over $10,000, about $11,000, is going to be to pay down the mortgage balance. And so at the end of your PCS cycle, you're still going to owe $288,000 on that mortgage, right? And this is called an amortization schedule. And the best thing you can do, I use either Bankrate or I use calculator.net. There's a couple other online calculators that you just put in your mortgage terms, and then they give you an amortization schedule. When you actually get a loan, you'll have an amortization schedule from the lender, so you can see what your payments are and how they're broken down. And those two parts are, again, the principal and interest. But it doesn't stop there, right? Because banks are, well, they want to make money. So what do? They also have an escrow account for you. And now you might have heard of the acronym PITI, which is principal, interest, taxes, and insurance. And the taxes and insurance, when you sign the paperwork for your loan, and they're like, hey, sign here, this is for your escrow account to open this. And what that means is you don't have to ever worry about taxes or insurance. We're going to pay it for you. And you're like, sweet, that's a good deal. But now you're like, wait, I thought my payment was $1,800 a month, but instead it's $2,400 a month? That's crazy. What are we talking about here? Well, what the bank does is they take $600 a month from you. They put it in their account. Over the course of the year, that's $7,200. And then at the end of the year, they'll pay your insurance premium, which is probably like $1,200, and they'll pay your property taxes, right? And then they might give you a little bit back, or they might just say like, hey, look, you have a surplus. We'll adjust down your escrow payment. Instead of $2,400 a month, now you only got to pay $2,350. We took too much of your money. And you're like, oh, my mortgage payment went down. But think about it. They just took all that money, they put it in their bank, and then they made interest on it, or they lent it out, or they made investments, they made profits. And there's a good chance that they turn that $7,200 that you paid them in escrow into about $10,000. So they're making profit on that as well. If you can, when you're working with a lender, you should ask, hey, can I skip the escrow account? I would like to take care of my own taxes and insurance. It's not hard. The county is going to send you the tax bill. Your insurance company will email you your insurance bill, and then you just pay it, right? Your mortgage payment will be lower. And the money you save each month, you can be investing. You could put in a high-yield savings account, and then every year when it's due, you saved up $7,200, plus you earn $500 in interest. Then you pay off your bills, and you still got $500 left over, right? You could turn yourself into a bank so long as you ask your lender if you can do that. Not everyone's going to do it. Some are going to say, no, we don't allow that. And you got to sign the paperwork, right? And it sucks, and they can do that. Nothing you can do. But the PITI are the 4 parts of your mortgage payment, and the amortization schedule is the behind the scenes showing you how much is going. So just because your payments stay the same doesn't mean the breakdown also stays the same. For example, we said your first payment on this $300,000 VA loan, $300 to principal, $1,500 to interest. If you hold on to that house for, let's say you get a PCA, so you don't move, you stay in it for 2-3 year tours, and you've been in there for six years. Now, $450 a month is paying down the principal, and only $1,350 is going to interest. Well, let's say you actually want to keep this as a rental. You're going overseas for 4 years, then you come back, spend another 3 years in that house, and now you're ready to sell. Well, at that point, $700 a month is going to principal and only $1,100 interest, right? So over time, you pay less and less interest. And that's worth taking a look at and making sure that you are tracking on with whatever loan you get. Now, the final part of your mortgage payment could be mortgage insurance. Mortgage insurance is something that is charged anytime you pay less than 20% down. And the 20% down, it's like making sure you have skin in the game. The bank doesn't want to be the only one holding if things go bad. Like if your $300,000 house suddenly drops in value by 10% down to $270, well, if they lent you that full $300, they don't want to, only get $270 back for the house. If for some reason, you're incapacitated, you pass away, and they got to take back the house and try to sell it, they want to get all their money back. So they make most people put 20% down because it's almost never, ever, like twice in history, has happened that the housing market's gone down 20%. So that they feel safe with that. And the way that they cover the gap is if they let you make a smaller down payment, say only 10%, the way they cover the gap is they go out and they buy insurance from some other company. But they're not going to pay for that insurance. You are. And that's where the mortgage insurance comes from. It's not a penalty because you didn't have enough cash to put a down payment. It's so that the bank can go buy gap coverage from a reinsurer like Allianz Bank, for example, which is like the biggest reinsurance sales, volume in the world, or at least it was a few years ago. And so that can add, depending on your credit score, that'll add anywhere from 0.5 to 1.5% of your total loan balance as an annual premium. So let's just assume that you've got a 680 credit score, $300,000 loan. You put less than 20% down, so you have to pay mortgage insurance, and you get a 1%. Your premium's 1%. That means $3,000 a year for mortgage insurance. That's $250 a month. Is that right? Yeah, $250 a month in mortgage insurance. So that could feel painful. Like your $1,800 mortgage payment for principal and interest now is $2,050. It went up over 10% just because of that mortgage insurance. And what we want to end on today is, as we just kind of wrap up this bit about like what goes into your mortgage payment and mortgages and financing in general, is for a lot of reasons in a lot of households, people think that looks like a scam and they do whatever they can to avoid it. So even a couple that has 800 credit scores, right? Like they both make six figures. They will still, scrap and claw to put 20% down on a $750,000 house. They're going to scrap and claw for like 6 years, save up $150,000, and go slap that cash down on that house. Now they wiped out all their savings, all their war chest, all their emergency funds just to buy this dream house that they had with 20% down. But they've got phenomenal credit. They've got stable employment. They're like GS 14s, right? Like they're never going to get fired. They got 6-figure salary. They got a pension plan. If they had gone to that lender and said like, hey, look, we don't want to pay 20% down. We want to do 10% down. The lender would look at it and guarantee they qualify them. They'd probably charge them like 2% points up front. So they charge them $15,000 up front as a fee, one-time fee. And then they'd slap on mortgage insurance. And the mortgage insurance would come out to, it'd probably be about $400 a month. So say $5,000 a year in mortgage insurance payments, plus the $15,000 fee. They saved $75K on their down payment. So that means they can own that house for 12 years before they've paid out $75,000. Now just imagine if you break that down even further, if they had the 150, they could have invested $75K. Invest in the stock market. Go buy a rental property, cash flowing rental property out in Des Moines, Iowa or something like that. Des Moines gotten a little bit, they're growing up, they're getting pretty nice and a little more expensive, so probably not 75K might not get you that there, at least cash, right? But if they took that 75K and then they invested it into cash flow that was making, say, $500 a month cash flow from a rental property, that cash flow would pay their mortgage insurance. Plus they've got another rental, growing equity that they're going to sell later. And they're going to save all of that cash that otherwise they would have had to put towards a down payment. So start thinking like an investor. Start thinking like somebody who knows a little bit about math. Stop thinking like this desperate first-time home buyer who's like, I got to save my 20%. And as we talk about in our next episode on the VA loan, we'll also explain why this is a good way to look at it and why in a lot of cases you should not do a 0 down VA loan. You should do like a 5% down or maybe a 10% VA loan. You could do 20 if you want, but I don't recommend it. Kind of for the same reason I just said, if you can get away with it, skip the 20% down and go for 10 or 15, pay the mortgage insurance, and you'd have to pay that for in some cases 20 plus years for it to become the same, as bad a deal as paying 20% down, right? So, all right. I think we definitely talked over an hour. I didn't plan to, probably because I babbled too much in the beginning, or maybe the middle and the end. I don't know. But anyway, hopefully that was a very good foundation laid on mortgages and financing and the history and the rules and why they're special. And we're going to just sign off here, and we're going to come right back with our next episode on the VA loan specifically. So until about 5 minutes from now when I start recording again, stay financially fit and mission ready.